The SVB collapse has now caused a deadly contagion and everyone is panicking. And the big victims are the US regional banks. Now, we have said many times that the financial system runs on trust, and when that trust evaporates, the entire US economy will be in panic mode. We have the regional banks seeing a crisis of confidence as investors are starting to pull their money away from the stock market. Now, what we are seeing is a brutal wave of carnage across the smaller mid-sized banks. First Republic Bank has crashed by almost 80%, Western Alliance crashed by 85%, and PacWest dropped by 60%, hitting a record low. Investors have turned their backs on the regionals. Even the largest banks saw an initial drop in their stock prices as well. I want to stress that this banking crisis probably isn't over yet. We have seen two banks collapse. SVB and Signature Bank are finished, but that is just at 4.5% interest rates today. So just imagine when the Federal Reserve hikes rates up to 5%, 6%, or even 7%, how many more banks will be exposed when the tide recedes? Because maybe the depositors could be safe, but the bondholders and the stockholders will be in big trouble. We have the ratings agency Moody's downgrading Signature Bank's debt to junk status as 6 more banks are under review for downgrade as well. And this includes First Republic, Zions, Western Alliance, and Comerica, just to name a few. And why are they getting singled out? It's because just like Silicon Valley Bank, they have a ton of deposits that aren't insured. Filings show that 68% of deposits were uninsured at First Republic, and this means a lot of deposits are sitting above $250,000. And if a collapse happens, a lot of money could be lost unless they get bailed out again. Sure, we have Joe Biden telling the world that the US banking system is safe and we shouldn't panic. He has also vowed consequences for SVP management. He wants to punish the people on top, but it is a little too late. And as you'll quickly see, there isn't enough money to bail out everyone. And this is the problem today with the banking system, especially in US banks. They have gone far off the deep end, away from the traditional deposit and loan business. Now the banks are buying up assets and hoping for their bets to work out. Just take SVB for example. We can see that their total investment securities at $120 billion are far larger than their loans business, which is only at $73 billion. In fact, it was over 56% of total assets. That is a lot of money in treasury bets. Now, SVB was horribly exposed to rising interest rates, and every time Powell hikes rates up, the banks suffered horrible losses on their books that sooner or later they had to realize, and this led to the collapse of Silicon Valley Bank. Now, investors are starting to wake up and realize that, hey, other banks could also be exposed to interest rate risk, and they began pulling their money out to the point of trading halts. The panic got worse because there was so much selling. The exchanges actually halted trading. The volatility was so extreme they had to stop trading multiple times. And this isn't good news, especially if you are a seller. By the time you get back to selling, the stock could have plunged further and now you are screwed. And it is this fear that's going to put more stress on the banking system that could cause even more bank runs to happen. We know that money is leaving the banking system and they are going towards gold and US treasuries. We can see the gold price smash past 1900 a few days ago, shortly after the collapse of SVB, and this tells us that trust in the banking system is shattering. Depositors now understand the words counterparty risk and they are choosing a true store of value, which is gold. But that's not all. Money is also flowing to treasury, sending bond yields tumbling, the biggest 3-day decline since the stock crash in 1987. We have the 2-year yield dropping down by 100 basis points in just a week. Just look at this epic drop in bond yields. This isn't normal. It is signaling to the world that investors are panicking. That is money leaving the banking system and deposits and investors plowing cash into bonds that can't default because the US government, through the Federal Reserve, can always print up a bunch of money to pay back holders of the US treasuries, but the banks can't print money. But whether money flows into gold or bonds, this is bad news for banks because the liquidity from their main funding source, which is deposits, could be drying up. And this is the big danger of rising interest rates. Remember the environment we are in. Depositors have already seen 2 banks collapse and the yields on the treasuries are hitting nearly 5% on the nearer end. So if they pull money out of the bank, it can create a self-fulfilling prophecy that could collapse any bank. This is the contagion fear that is dragging regional banks down to hell. According to analysts, investors smelling blood then turn their attention to the next bank exposed to interest rate risk and Pacific credit risk. And their attention has turned to First Republic Bank, which has significant exposure to the coastal real estate markets, appears to be next on the list. And we can see from their 10K filing that the bank has over $166 billion worth of loans, most likely from their real estate book. Now, that is 78% of their total assets or 94% of their deposit liabilities. Once again, this is a very high percentage, but it isn't unusual. The loan business is the bread and butter of banks. This is fine and shouldn't be a problem in a low interest rate environment. Borrowers can easily repay their loans if they are locked in at a low rate. But the problem comes if borrowers default as rates go up. How many mortgages were written as adjustable rates, we don't know. According to the Federal Reserve, back in 08, delinquency rates had risen to over 29% on adjustable rate mortgages. Now, the fixed rate delinquencies also rose to 9% because of higher interest rates back then. People were just too broke and unemployment rose, so they couldn't pay back their mortgages. And here's the thing about mortgages. They can be sold off as securities to other banks, also known as mortgage-backed securities, right? Or MBS. Yes, you get to raise money fast, but you will likely take a haircut if you have a fire sale. Other banks will pay you less than the original value because now interest rates are higher and you're desperate. And that is why First Republic just got additional funding from both the Federal Reserve and JP Morgan. They now can access an additional $70 billion as a backstop if a bank run happens, so they will likely be fine. They should have enough liquidity to tide through thanks to this lifeline. But this is how bad the situation has gotten. We have big banks propping up the smaller regionals, plus the government now trying to rescue everyone. And once again, we need to take high interest rates more seriously. US banks are sitting on unrealized losses of $620 billion, which is only going to grow as interest rates go up. And if depositors get freaked out and they want their money back, this bank run could cause another liquidity crisis. Then the banks will have to realize those horrible losses. And guess what? The government could step in and bail them out again. And let's talk about bailouts. I think a lot of us misunderstand the depositor bailout given to SVB. Now, this isn't a bailout for the little guy. It was a bailout of the tech industry. And if you didn't know by now, the US government has guaranteed all deposits at Silicon Valley Bank. According to the regulators, depositors will have access to all their money starting Monday. That means both insured and uninsured deposits, even those above the standard amount of $250,000. Now, this sounds like great news until you realize that almost 90% of SVB's deposits were uninsured. A huge chunk of money is from the big VC firms and technology companies. This is basically investor money from the rich. So yes, I'm sure the bailout saved the deposits of many workers, which is good news, but this also helped to bail out the rich. The Republicans are now hammering the bailout, calling it a giveaway to the rich. They are taking the insurance premiums that were paid in to protect depositors under $250,000, which are the little guys, and using it to cover deposits of the very rich. The big problem with saving every deposit is now you have set a bad precedent. If you guarantee every single deposit in the SVB collapse, you'll have to do the same if another bank collapses, or it will be a clear sign of double standards. The US Treasury has said the Deposit Insurance Fund, or the DIF, has over $100 billion in it, more than sufficient to cover both SVB and Signature Bank deposits. But do they have enough money to cover all depositors in the United States? Let's look at the data from the FDIC's own website. The designated reserve ratio sits at only 2%, and that means there's only enough money in the FDIC to cover 2% of estimated insured deposits in the FDIC insured banks. It has been at 2% for more than a decade, but it gets worse. The FDIC today doesn't have enough money even for 2%. They reported having only $128 billion in reserves, or just 1.27% of total insured deposits. Remember, we aren't even counting in the uninsured deposits yet. So if a chain of bank runs happen, the DIF will have to find additional money as a backstop to secure the depositors. And because they build out the uninsured money in SVB, they have to do the same for all depositors, or there will be chaos. And where this money going to come from? The US Treasury will likely have to go to the Federal Reserve to issue new bonds and print new money to existence. Yes, I believe the FDIC will bail out depositors. They won't default, but it could be at the expense of the taxpayer and higher inflation. That's why the blanket deposit guarantee for the SVB has set up a big moral hazard for future depositor bailouts. And this brings us to the future of banking. It is very likely we will witness a consolidation of the banking sector, as we have seen smaller regional banks aren't as diversified as the big boys. They have a lot of concentrated exposure in specific segments such as US treasuries or mortgage loans, and as interest rates start to go up, their balance sheets are taking a horrible beating. But the big banks, they are very different. They have stronger positions and their assets are more diversified versus the smaller players. And this is the big tragedy I see going forward for US banks. The big banks will continue to get bigger as depositors pull their money out of regionals, throwing them into the big boys. We have the Financial Times reporting how large US banks are getting flooded with new depositors as the bank run continues. Money is flowing out of the regionals and into the bigger and safer banks. And why do I call them safer? It's because if a crash happens, they will be the first in line for a bailout. And what does Bank of America, JP Morgan and Citibank have in common? They are all part of the G-SIBs or systemically important banks. In other words, they are too big to fail. And here's the list of the G-SIB banks. The higher they are on the list, like JP Morgan or Citibank, the more important they are to the financial system. If a bailout comes, they are likely first in line for a bailout, because if they collapse, the entire economy will probably crash as well. That is why a ton of money is rushing into the giant banks. It's no coincidence that depositors are running to JP Morgan, Citibank, and Bank of America. They are at the top of the G-SIB list. They are simply too big to fail. And this is what I foresee in the US banking sector going forward. The big banks will continue to grow and buy over the weaker regional banks if anything happens. We already have HSBC paying £1 to rescue the UK arm of Silicon Valley Bank. They are doing this because they can weather the storm. Plus, they now have access to SVB customers and their network. According to their CEO, their acquisition strengthens our commercial banking franchise and enhances our ability to serve innovative and fast-growing firms. So the big banks are only going to get bigger. And if I had my money in the US, I would put it into a big G-SIB bank as well, because they are just too big to fail. So let's understand how bad things can get. It's all about interest rates now, and we need to watch the Fed meeting in March, which is just a week away. Goldman Sachs believes the Fed isn't going to hike rates this month. They believe it will cause more stress on the banking system. In fact, we can see markets pricing in a 20% chance of a 0% rate hike. They don't believe Powell would dare to jack rates up. But I don't think that's the case. I think the Fed is going to still raise rates. Maybe not by 50 basis points, but at least by 25. Because inflation is still a clear and present danger. The battle isn't won yet. We still have enormous war spending on the fiscal side. The economy still looks good to the Federal Reserve, with payrolls rising by over 310,000 in February. To the Fed, the state of the economy is still strong and unemployment is still very low. So rates are likely going to hit higher. The pain isn't over yet. Bond yields are going to hit higher, and we just don't know how bad the situation can get. And China obviously isn't coming to save the US after all the threats made against them. They aren't buying US treasuries, and in fact, they have reduced their bond holdings month after month. The Federal Reserve, they have made a deal with the devil for far too long. The devil being low interest rates, and now he's here to collect. So hang tight, because the show isn't over yet. But let me know what you think in the comments below. Is the banking crisis over? Will the Federal Reserve continue to hike rates up? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.